Ladies and gentlemen, welcome to Asian Guy Analysis on January 14th, 2026. Right now, gold is widely considered the ultimate safe haven for investors, the asset that protects wealth when markets shake. But something unusual is happening with silver, an often overlooked metal. A $62 Shanghai spread has emerged, a signal that could make silver more volatile and potentially riskier than gold in the current financial landscape. Most investors only glance at the prices of gold and silver without understanding the forces driving them. Silver is not just a commodity for investors. It's a key industrial metal used in electronics, solar panels, medical equipment, and countless other applications. Its dual role as both an investment and an industrial asset makes it extremely sensitive to sudden market shifts. The 62 spread in Shanghai represents the difference between the local market price for physical silver and global benchmarks like COMEX. Historically, spreads like this are rare and often indicate either tight supply or heightened demand, or both. When such a gap appears, it can create sudden and dramatic price movements, catching traders and investors off guard. Today, we'll explore why silver's risks are rising, why gold remains comparatively stable, and what the Shanghai $62 spread reveals about the potential turbulence in the silver market. By the end of this video, you will understand why investors need to rethink silver AS role in their portfolio, and how this hidden signal might impact markets worldwide. To understand why silver might be riskier than gold today, it's important to look at history. Gold and silver have been linked for centuries, yet their market behavior is fundamentally different. Gold has long been the ultimate store of value, trusted during economic uncertainty because of its stability and global demand as a hedge against inflation and currency fluctuations. Silver, on the other hand, has always been more volatile. It has fewer global reserves and is heavily influenced by industrial demand. During financial crises, silver often reacts faster than gold, sometimes sharply falling, then rebounding violently. A clear example is the 2008 financial crisis. Gold's price steadily climbed as investors sought safety, but silver initially plunged due to liquidity constraints before bouncing back as demand for physical silver surged. This volatility stems from a few key factors. First, silver has smaller market size compared to gold. This means even moderate changes in supply or demand can cause significant price swings. Second, industrial demand plays a major role. Unlike gold, which is mostly hoarded or used in jewelry and finance, silver's use in solar panels, electronics, and medical devices ties its price directly to production cycles and technological growth. In recent years, silver has gained attention from investors seeking higher returns during inflationary periods. ETFs, futures, and speculative trades amplify volatility, while gold's market remains more stable due to deeper liquidity and broader global distribution. Today, these historical patterns combine with an emerging factor, the Shanghai $62 spread. This unusual pricing gap could indicate significant pressure in the silver market, creating risks that many investors who only follow gold may not anticipate. The Shanghai spread refers to the price difference between physical silver in Shanghai and the benchmark prices on global exchanges like COMEX. In simple terms, it's the premium investors are willing to pay locally compared to international prices. Right now, this spread sits at an unusually high 62, a signal that experts rarely see outside extreme market conditions. Why does this spread matter? When local demand exceeds supply or physical delivery constraints appear, premiums rise sharply. In Shanghai, the spread reflects both a surge in local industrial consumption and strategic buying by investors and traders preparing for potential shortages. Silver is not just a commodity, it's a tool for manufacturing, which creates a complex demand structure beyond just investment speculation. Historically, a spread this high suggests potential market instability. If the gap widens further, silver's price could react sharply, causing ripple effects in futures markets, ETFs, and physical silver trading worldwide. Traders who ignore the Shanghai spread could face sudden losses if the market shifts rapidly. Some analysts point out that this isn't just about supply. Geopolitical factors, export regulations, and shifts in industrial policy in China also influence the spread. For example, any restrictions on silver exports or increased domestic usage could drive local premiums even higher, magnifying volatility for international investors. Understanding the Shanghai 62 spread is crucial for investors who want to grasp why silver is riskier than gold right now. While gold continues to act as a predictable store of value, silver is reacting to industrial forces, market speculation, and local premiums, creating a volatile combination that demands attention. Silver's current risk profile is shaped by several hidden forces. First, industrial demand is surging. The global push for solar energy and electronics manufacturing has created unprecedented demand for silver, straining supply chains. Factories and manufacturers compete with investors for the same physical silver, intensifying price fluctuations. Second, investor behavior amplifies volatility. Silver ETFs and futures attract speculative traders who react quickly to news, market trends, and technical signals. Unlike gold, where large institutional holdings stabilize price, silver's smaller market can swing dramatically on relatively small changes in buying or selling activity. Third, geopolitical factors cannot be ignored. China's dominance in silver consumption and production makes the Shanghai market critical. Policy changes, trade restrictions, or shifts in export priorities can dramatically alter the global supply-demand balance, directly impacting international prices. Compare this with gold. Its reserves are more widely distributed, and it is less tied to industrial use, providing a cushion against sudden shocks. Silver, due to its dual role, is more exposed to both industrial disruptions and financial speculation. Finally, the $60 Shanghai spread highlights the fragility of silver's current market structure. It indicates that local physical demand is so high that global benchmarks fail to reflect the real price pressure. For investors, ignoring the spread is risky. It's a warning signal that silver markets may experience sudden, severe moves, much faster than gold. Now that we understand the Shanghai $62 spread and the hidden risks behind silver, it's time to explore what this could mean for the global market. Investors often assume that silver will simply follow gold during periods of uncertainty. But with the current spread and underlying market dynamics, silver could behave very differently, and in ways that may surprise even seasoned traders. First, consider the implications of a widening spread. When the Shanghai premium continues to rise, physical silver becomes more expensive locally, while international prices may not immediately reflect this gap. This creates a situation where traders and manufacturers may face sudden cost pressures. Industrial users, including solar panel producers, electronics manufacturers, and medical device companies, might have to pay much higher prices, potentially slowing production or forcing them to find alternative solutions. At the same time, investors holding silver ETFs or futures contracts are exposed to this divergence. Sudden adjustments in local supply or demand can trigger sharp moves in futures markets, causing price spikes or rapid sell-offs. Unlike gold, whose global reserves and deep liquidity buffer against such shocks, silver's smaller market size magnifies these effects, creating higher short-term volatility. Let's break it down with potential scenarios. Scenario 1. The spread widens. Further, if local demand in Shanghai continues to rise, or if supply tightens, the premium could increase even more. Physical silver could surge in price locally, creating arbitrage opportunities, but also risking a sudden global correction when traders attempt to align international and local prices. Scenario 2. The spread narrows. Suddenly, a sudden correction could occur if industrial demand drops, export rules change, or speculative investors exit the market. In this case, silver futures might experience a sharp decline, catching retail investors off guard. Gold, in comparison, remains far more predictable. Its role as a hedge, lower industrial dependency, and broader market liquidity make it less vulnerable to short-term spikes or drops. This is why silver, despite being cheaper and more accessible, carries higher risk for both short-term traders and long-term holders. Another factor increasing the risk is leverage. Many traders use borrowed funds to speculate on silver ETFs and futures. A sudden price movement triggered by the Shanghai spread could force margin calls, further accelerating volatility. In essence, the $62 spread isn't just a number. It eons a warning about how fragile silver mass market structure is under current conditions. Finally, this volatility could have ripple effects on broader financial markets. Investors often link precious metals with inflation expectations, currency strength, and geopolitical tensions. A sudden shock in silver prices could impact ETFs, commodities, indexes, and even related industrial sectors globally, making it a systemic risk. In short, the 62 Shanghai spread is more than just a local anomaly. It acts as a bellwether for global silver market instability. As we wrap up, let's summarize the key takeaways. The Shanghai $60 spread is a rare and significant indicator that silver may be facing heightened risk, even as gold continues to hold its reputation as a safe haven. While gold investors can rely on steady performance, silver OS, dual role as both an industrial commodity and investment vehicle, exposes it to sudden market shocks. Investors should monitor 3 key factors moving forward. Shanghai premium movements. Watch how the $62 spread changes. Widening or narrowing could indicate emerging market pressures that may affect global silver prices. Industrial demand shifts. Silver's extensive use in electronics, solar energy, and medical equipment makes it highly sensitive to production cycles and technological adoption. Sudden changes in industrial consumption could trigger market moves. ETF flows and futures volume. Large movements in silver ETFs or futures trading can amplify volatility. Speculative positions, margin calls, and arbitrage between markets increase the speed and intensity of price swings. For investors, this means that while silver may still offer opportunities for gains, it requires careful strategy and risk management. Blindly treating silver as a cheaper gold could be dangerous under current conditions. The Shanghai $60 spread serves as a warning signal, a market red flag highlighting potential instability. Looking ahead, silver's volatility may continue to create both risks and opportunities. Traders who understand the spread, track industrial demand, and anticipate speculative market behavior will have a strategic advantage. Gold remains the safer hedge, but silver could provide short-term opportunities for those prepared to navigate its complexity. Ultimately, the $62 Shanghai spread reminds us that the precious metals market is more interconnected and sensitive than it appears. Market participants must stay informed, analyze real-time data, and avoid assumptions based solely on historical patterns. By paying attention to hidden signals like this, investors can better position themselves to manage risk and take advantage of market dynamics.